I'm Kevin Austin, founder and commercial director of Access Financial. Today, I want to talk to you about a crucial topic for any modern recruitment business: unlocking global expansion by managing mobility risks. The global workforce has never been more interconnected, but with opportunity comes new and complex challenges. With a post-Brexit and post-pandemic world, a fragmented and inconsistent set of rules has emerged across different countries. Placing candidates in international roles, whether they're permanent or remote, carries significant risks, from taxation and social security to immigration and employment law. One wrong move in handling global mobility can result in severe penalties, reputational damage, and legal exposure for both your agency and your clients. Conversely, operating compliantly on an international scale allows you to broaden your talent reach, attract global clients, and expand your business with confidence. By staying ahead of evolving labor laws, tax regulations, and data protection standards, you can manage cross-border placements effectively and win the trust of everyone you work with. Today, we're going to focus on two of the most critical global mobility risks that recruitment firms must master: permanent establishment and tax residency. A major and often hidden risk is permanent establishment, or PE. Simply placing a candidate abroad can unintentionally create a taxable presence for a client's business in that host country. This triggers corporate tax liabilities and a whole host of regulatory obligations. Without proper management, your clients could face retroactive tax bills, intrusive audits, and significant reputational damage. Now, PE risks can be broken down into three main types. The first one is a fixed place of business. That can be triggered by having a physical office, a factory, or crucially, even a remote employee's home office if the company dictates its setup. Next is a dependent agent PE. This happens when a tightly managed employee or contractor in a foreign country regularly signs contracts or closes deals on behalf of the business. Finally, some treaties include a service PE, which is triggered when a company provides services in a country for an extended period, such as more than 6 months. So, how do you reduce this risk? Both recruiters and clients should take proactive steps. This means reviewing double taxation treaties, analysing the functions of employees, and limiting the local authority of foreign-based staff. It also involves monitoring the number of days employees spend in a country and implementing clear remote work policies. The most effective way to ensure compliance and shield businesses from PE risk is to use an employer of record, or EOR. They provide a compliant hiring structure that protects both you and your client. For long-term operations, it may be better to establish a local subsidiary which provides a clear legal and tax presence. The second major risk is understanding an individual's tax residency. This determines where a person is legally required to pay personal income tax, and it has immediate payroll consequences for the employer. Key residency tests include the physical presence test, where a person is considered a tax resident if they spend a certain number of days, often 183, in a country. The permanent home test, where simply having a permanent residence can indicate tax residency regardless of the number of days. And the Centre of Vital Interest test, which assesses where a person has their strongest economic and personal ties. If a worker is a tax resident, the employer may be required to register with a local tax authority, set up and run a local payroll, and withhold income tax and social security contributions. Non-compliance can lead to backdated taxes and severe penalties. The bottom line: the tax residency of an individual is directly linked to the employer's PE risk. By implementing global work policies, monitoring employee locations, and consulting with global mobility experts, you can ensure compliance. When in doubt, hiring through an EOR is the most efficient and compliant method. The EOR becomes the legal employer and assumes full responsibility for local payroll and taxes. For long-term assignments, a local entity can provide a clear framework. Understanding these risks is absolutely vital for successful global expansion and for building a reputable, trustworthy recruitment business that stands out from the competition. In a world where global mobility is becoming the norm, these risks are no longer abstract. They're tangible threats to your business. But with the right strategy and the right partner, they become manageable. At Access Financial, we help you navigate this complex landscape, turning potential risks into opportunities. We provide the expertise and structure needed to place talent anywhere in the world compliantly and with confidence. This frees you up to focus on what you do best, finding the best talent for your clients, no matter where they are. Well, thanks for watching. If you're ready to simplify your global mobility journey, head over to our website to discover how Access Financial can support you every step of the way. Don't forget to like, share, and subscribe for more insights.